Welcome back to RegTalkUK, the deep dive that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie.
Well, if you were hoping for a quiet run-up to Christmas, I think the regulators had other ideas.
They certainly did. This week feels like the definitive empty the outbox edition.
Absolutely. We are looking at a stack of papers released this week, the week ending the 19th of December, that are so significant. I mean, they're not just small changes. They genuinely define the agenda for the first half of 2026.
That's right. The sheer volume is one thing, but it's the philosophical shift that should really command attention. We've seen, three major developments?
At least.
First, the FCA's new roadmap for mortgages, FS256. It explicitly accepts what they're calling a tolerable level of harm.
Which is just a huge change in mindset.
A complete rupture with the post-2008 era. Then we got the colossal 450-page crypto rulebook, CP2540. It moves the UK well past just AML checks and into a full prudential regime. And third, the Bank of England gave us a deeply divided, really nail-biting interest rate decision.
So a revolution in lending, a new rulebook for a whole asset class, and economic instability. Let's start with that philosophical pivot on mortgages. It sounds seismic.
It is. This is FS256, and it's the biggest reform since the mortgage market review back in 2013. For years, the default setting has been, eliminate all risk. The FCA is now openly rejecting that. The key quote is that regulation should enable informed risk to be taken, not eliminate it entirely.
Okay, let's just stop there for a sec. That sounds great in a press release, but if the FCA accepts a tolerable level of harm, who defines what's tolerable?
Well, that is the central tension, isn't it?
And how do banks stop themselves from just pushing right up to that new limit?
The onus is now entirely on the bank's own governance. The tolerance is conditional. It might mean accepting a managed increase in arrears, but only if the payoff is a better consumer duty outcome.
Like getting first-time buyers onto the ladder who were previously locked out.
Exactly. But the banks must be able to prove it, with really robust data. It's a green light for innovation and affordability models, but only if the governance is flawless.
So the regulator's saying, we trust you, but you have to prove it. It shifts the accountability.
It really does. And we know what's coming next. We're expecting a joint FC's-Capra consultation paper in Q1 2026.
And that will focus on what, specifically?
It's going to be heavily focused on high loan-to-income, or LTI, lending, and updating guidance on credible repayment strategies.
You mean for things like later-life mortgages?
Later-life mortgages, yes, but also, and this is critical, on using rental payment data in affordability assessments. For a whole generation of renters, that's their main financial track record. Okay,
moving from bricks and mortar to bits and bytes. This crypto rulebook, CP2540, 450 pages. I mean, what's the headline?
The headline is, the UK has officially moved on. We're not just an AML registration regime anymore. This is a full conduct and prudential system.
Which is what the big institutions have been asking for, right? Clarity.
They've got it. But it comes with a significant compliance cost. The FCA's own assessment, though, projects a net benefit of about $287 million over 10 years.
And they think that's from what? Increased consumer confidence?
Primarily, yes. They're betting that trust built through proper regulation outweighs the cost of getting there.
So when you dig into those 450 pages,
yeah,
where are the real hard lines? The things that will force firms to change how they operate?
You go straight to lending and borrowing. The FCA has taken a very clear lesson from those big failures in 2022, Celsius and BlockFi. The new rule is explicit. Firms cannot use their own proprietary tokens in connection with their lending services.
That's huge. That was the core conflict of interest that brought those firms down.
It was. That link is now severed in the UK. And for retail borrowing, two new protections are mandatory. First, over-collateralization.
Standard practice in traditional finance, but now applied to crypto.
And second, mandatory negative balance protection. It means the retail client can't owe the firm more than the collateral they pledged. It puts the credit risk from a market crash back onto the platform.
That's a vital distinction. And what about market transparency?
For large platforms, and that's defined as having over £10 million in annual revenue, they now have to meet pre-trade transparency rules.
So publishing bid offer spreads, that sort of thing.
Exactly. It's a massive step towards institutional grade markets. And on staking, firms now need express prior consent from retail clients.
But they're not on the hook for technical failures, for slashing.
No. The FCA decided that was disproportionate for now. The technical risk still sits with the client. It reflects the overall philosophy, which Reg Pulse UK quoted from Sarah Pritchard.
Right, which was regulation cannot and should not remove all risk. Instead, it should make sure anyone investing in crypto does so with their eyes open.
That's it. It's a fence, not a padded room. The consultation closes on February 12th, 2026.
Now, let's pivot to something much older. Insurance claims. The FCA responded to that big witch, super complaint about home and travel insurance. They didn't launch a full market study, though.
No, they rejected that call. Their argument is that a huge, slow review isn't needed because they already know where the problems are and they're taking very targeted action.
And the data is pretty stark, isn't it? The context here is these persistently lower claims acceptance rates.
Dramatically lower. We're talking about home insurance sitting somewhere around 63% claims acceptance, while motor insurance is up at 99%.
That gap just screams consumer duty failure.
It does. So instead of a market study, they've deployed the supervisors. Since July, the FCA has already opened 2 formal enforcement investigations.
2 investigations already.
And they've commissioned S-166 independent reviews at 3 different firms. On top of that, senior managers at 3 firms had to formally attest to strengthening their controls.
Which puts the accountability right on their desks. It's consumer duty in action.
It is, and they've confirmed they are expanding their work on this into Q1 2026. So no market study, but a lot of direct supervisory heat.
Okay, let's move to a bit of regulatory freedom for a change. Contactless payments. Flexibility is coming in March 2026. What's changing?
Well, the FCA is basically allowing banks and payment providers to set their own contactless limits. The condition is they have to have strong fraud controls in place.
Which just reflects reality. I saw some Barclays research that said almost 95% of eligible in-store card transactions were contactless in 2024.
It's the default now. David Giel at the FCA said it plainly. Contactless is people's favored way to pay. This is part of their wider growth agenda, shifting responsibility back to the firms.
But let's be realistic. Most banks will probably keep the existing limits for a while, won't they? It's a tricky balance between customer convenience and fraud risk.
That's the consensus. The freedom is there, but no one wants to be the one to preside over a surge in fraud. So expect caution.
If you're finding this useful, don't forget to follow RegTalkUK on Spotify or subscribe on YouTube. It really helps us reach more banking professionals like you. Now, let's look at the macro picture. The Bank of England's rate decision caused a stir. What was the cut?
They cut interest rates to 3.75%.
But the real story was the vote, wasn't it? A 5-4 split. That signals a huge amount of uncertainty.
It does. It means the Monetary Policy Committee is almost evenly divided. You have 4 members who still think inflation is the primary risk and wanted to hold rates.
And Governor Bailey's warning that further cuts will be a closer call doesn't exactly build confidence.
Not at all. The market is pricing in maybe one more cut by the middle of next year, but that tight vote means nothing is guaranteed. It makes hedging a nightmare for bank treasuries.
And the backdrop is the labor market, which continues to look a bit soft.
Precisely. UK unemployment has ticked up to 5.1%, and youth unemployment is a particular concern, up at 13.4%. That certainly strengthens the case for cutting rates.
Okay, quick fire round on the neobanks. Monzo was busy.
Very busy. They made their first big acquisition, buying the digital mortgage broker Habito.
Tying back into that new mortgage framework we discussed.
Exactly. And at the same time, they secured their Irish license, which is their springboard into the EU.
And Revolut is still pushing to be the super app.
Yes. They launched their own mobile virtual network operator, an MVNO, so they're a mobile phone provider now.
Which brings them under Ofcom regulation. Another layer of compliance.
A very different layer of compliance. And just quickly on open banking, the user base has now hit 16 million. VRPs, variable recurring payments, are on track to launch in Q1 2026.
Okay, let's finish on the risk radar. And some of these updates are, frankly, terrifying, starting with climate risk models.
This is genuinely alarming. It turns out major UK banks, we're talking Lloyds, NatWest, HSBC, have been relying on climate research from the NGFS that was built on a retracted academic paper.
And the scale of the error.
Yeah.
It's just breathtaking. An error linked to data from Uzbekistan inflated the worst-case global GDP loss from 23% to 62%.
It almost tripled the projected worst-case damage. It just raises massive questions about the foundations of the climate risk assessments that banks and regulators are using.
If the core data is that fragile, what does that say about the models? And that theme of flawed central infrastructure extends to cyber risk with the UK's one login system.
Yes, this is a huge looming crisis. Whistleblowers are warning the system has severe security flaws. It reportedly failed mandatory standards and contains over 500,000 vulnerabilities.
500,000, with tens of thousands classed as critical. I've seen it described as potentially the worst data breach in history.
And every bank relies on that kind of central ID infrastructure. A failure there is a systemic event for the whole industry.
Compounded by the Foreign Office getting hacked by a group linked to China, the threat is very real.
And to cap it all off, we see the convergence of tech and high politics. The former Chancellor, George Osborne, has been hired by OpenAI
To lead their initiative focused on the global rollout of that $500 billion Stargate AI data center program.
Correct. His appointment just shows that AI infrastructure is now a matter of top-level political diplomacy. It's not just a tech issue anymore.
So what a week to end the year. We have a fundamental shift to tolerable harm in mortgages, a comprehensive new crypto rulebook, and huge pressure still on insurers.
And I think the final thought for our listeners heading into 2026 is this. The warnings about flawed climate data and catastrophic cyber risks in government ID systems. They show that risk for a bank is expanding far beyond just credit and liquidity. The real question is, how prepared is your risk function to handle the consequences of relying on central data and infrastructure that is flawed, compromised, and completely outside of your control?
That's all from us this week and indeed for 2025. Thanks for listening to RegTalkUK. We wish you all a very Merry Christmas and a prosperous New Year. Until next time, stay sharp and stay compliant.